Thank you all for being here. The following is an exclusive program at Texas Lutheran University called Bulldog Investment Company. My name is Ariana Bird. I am a team mentor, and I have been in the program for 2 years.
My name is Isam Jazzy. I'm a team mentor as well. I've been in the program for 3 years.
My name is Luis Green. I'm currently a team captain, and I have been in the program for 2 years.
My name is Dylan Wendell. I've been in the program for 3 years. I'm also currently a team captain.
Bulldog Investment Company is a student-managed investment fund that was founded in 2009 as an on-campus internship focused on critical thinking skills, financial statement analysis, and presentation skills. This program is not about stock trading, but was rather modeled after Warren Buffett's criteria for investing in good businesses. The program is open to all majors, and there are no prerequisites or prior knowledge of investing required, just the will to learn and work hard. We study Warren Buffett because he demonstrates that success in business and ethical behavior are not mutually exclusive. He has successfully compounded Berkshire Hathaway's market value 20% annually over the last 50 years, and it is a very logical as well as teachable approach. There are many benefits to students in this program. Internships can lead to permanent jobs, and presentation and critical thinking skills are valuable in any industry. Scholarships are available for top-performing students, and influential speakers come to campus each semester. This program will add credibility, depth, and experience to any resume. Our program is divided into 2 teams that compete by preparing presentations on companies based upon Warren Buffett's criteria. The top idea is then presented to a professional board of directors each month, and the winning team is that which best demonstrates a command of the company's financials, an understanding of the business and industry, and a compelling value. We also participate in a bull and bear competition, in which one team argues why we should sell an asset and the other defends why we should hold it. In the end, we vote and majority rules. This forces us to stay on top of our current holdings and make optimal decisions. Although most of the nation's top MBA programs offer a student-managed investment fund, very few undergraduate programs offer a program of this nature, especially one that allows students to manage over $800,000 of actual cash in a real portfolio. This gives TLU students a competitive advantage as this goes well beyond a simulation. All student presentations are documented on the Bulldog Investment Company website. As such, students not only gain invaluable experience, but also a real-world reference point when interviewing for jobs. This program teaches students that wise decisions make money and mistakes cost money. Warren Buffett and the Interpretation of Financial Statements is the textbook which we use. It is easy to read and gives us a good overview of what Warren Buffett looks for when investing in companies. If I ask you to name your favorite American sports car, you'll most likely name the Chevy Corvette, the Ford Mustang, the Chevy Camaro, but does that make these companies a good investment? Analyzing the data allows us to remove the bias and differentiate between good and bad companies.
So our program is predicated upon what we've learned from the great value investors, especially Warren Buffett. We subscribe to Buffett's #1 rule: don't lose money, recognizing that this is not referencing volatility, but rather the permanent impairment of capital. In managing our portfolio, we utilize 3 main investment strategies, which are long-term compounders, option contracts, and cash-out arbitrage. Most of the companies in our portfolio are long-term compounders. We are not day traders. Instead, we intend to hold companies for significantly long periods of time in order to maximize our rate of return and lower our overall tax burden. When analyzing long-term compounders, we look for companies that are predictable, consistent, and understandable. If you cannot understand a business's operations and it isn't predictable nor consistent in its financials, then how can you logically assess its intrinsic value? And after determining that a company is indeed predictable and consistent, we assess its economic moat. There are 4 basic types of moats that we look for. Intangible assets include things like brand names and patents. Nike has a very well-known brand name which drives market demand and delivers pricing power. Companies like Oracle benefit from their high switching costs. Because Oracle becomes so embedded in a client's operations, it is difficult for that client to switch to a competitor, even if that competitor may be somewhat cheaper. And thirdly, credit card processors like MasterCard and Visa benefit from the network effect. Most consumers nowadays expect to be able to purchase their goods and services with a credit card. So the more businesses that accept MasterCard and Visa, the wider their moat becomes. And lastly, companies like Union Pacific Railroad benefit from their cost advantages, allowing them to spread their fixed costs over a very wide base. All of this comes together to form a sustained competitive advantage. And after looking at the moat, we assess return on equity and return on capital. We recognize that Warren Buffett's favorite metric for measuring managerial efficiency is return on equity. So we prefer that both of these numbers to be above 15, or we require both of these numbers to be above 15% and preferably improving as the years go by. In addition to this, we also run a DuPont analysis on return on equity to see if our returns are coming from leverage or from growth of profits within the business. And after this, we look at our long-term obligation ratio. We use this to see if our investment candidates are able to self-fund their needs or if they're being overly reliant on investment bankers. We do this by first adding in short and long-term debt, a pension funding shortfall, preferred stock, multiply our leases by 7 and then add those in as well. And after subtracting out cash, we divide that result by our last year's annual net income to hopefully get a number that's less than 5, meaning that the company can pay off all of its obligations with less than 5 years of net income. In addition to this, we also analyze debt maturities to make sure there isn't a large chunk of debt coming due all at once, which may pose a refinancing risk. And only after measuring the qualitative factors in the financial statements do we look to see if there's a valuation gap.
Dollar General is a great example and one of our recent successes. Dollar General serves a wide variety of customers, targeting those with annual household incomes of $40,000 or less. Many of their customers cannot shop online and wait 2 to 3 days for delivery. 80% of their items are priced at $5 or less, and 75% of Americans live within 5 miles of a Dollar General. As such, it's understandable and in high demand. Since 2005, sales and profits have consistently grown in both good and bad markets. Sales have grown at 286% since 2005. That's compounded annually at 10%. Profits have grown at 475% since 2005. That's compounded annually at 12%. This shows that Dollar General is both predictable and consistent. Dollar General keeps overhead low by operating their stores with 3 to 4 people. Furthermore, they effectively use logistics and distribution systems to derive greater efficiency. All of this creates cost advantages. Once we determine that a company meets Buffett's criteria and that it possesses a sustained competitive advantage, we assess valuation. We use value bands to examine a company's historical valuation over an extended period of time. The red line represents the 80th percentile threshold of historical valuation, indicating that the business might be overvalued. The green line represents the bottom 20th percentile threshold of historical valuation, indicating that the business might be undervalued. In 2016 and in 2018, we purchased Dollar General near or at that bottom 20th percentile threshold in various different metrics, including price to earnings, price to cash flow, price to sales, and price to free cash flow. In addition to using value bands, we paired this analysis with a 2-stage discounted cash flow analysis. Since entering Dollar General, we have produced a 36% annualized return or accumulated return of 144%. As such, Dollar General is understandable, predictable, and consistent. It possesses a sustained competitive advantage, and it was offered at a value gap.
So occasionally we use option contracts to identify strategic entry as well as exit points for long-term compounders and to enhance our cash flows at times when interest rates are at historic lows. Option premiums have added an additional 1 to 2% to our per year cash flow, and whenever we write option contracts, our puts are cash secured and our calls are covered. So although Warren Buffett is most well known for his long-term compounders, if you study some of his partnerships from the 1950s, there are a number of strategies that are still applicable today. One of those is a cash-out arbitrage. Not only can a cash-out arbitrage add solid returns to a portfolio, but it can also help to smooth out volatility in a bumpy market. A cash-out arbitrage opportunity arises whenever one company announces its intention to acquire another. We have a set list of criteria that we have to follow whenever we want to take part in one of these deals. 1, it has to be an all-cash deal so we can calculate and anticipate the rate of return. 2, it has to be a friendly merger as we're not interested in taking part in a hostile takeover. 3, there must be low or no regulatory hurdles. 4, the money has to actually be in place for the deal to go through. And 5, there has to be a significant enough discount to the final price. An excellent example of this is whenever Novartis announced their intentions to acquire Abexis at $218 per share. We entered the position at $207 per share, and the deal closed only 28 days later. This produced a 5.3% gross rate of return, or over 68.6% on an annualized basis. Since inception, the Bulldog Investment Company has closed 17 total arbitrage transactions, all of which have produced an average annualized rate of return of about 36.5%. So although we love buying companies, we also know that we have to be prepared to sell. We'll consider selling companies if they reach historically high levels of valuation, if they have a sudden or a dramatic increase in debt, if they have worsening operating or net profit margins, or an eroding economic moat, which you often find manifesting itself within those above-mentioned characteristics. We're also willing to sell a company simply if we find a better opportunity. We must also remember to never fall in love with any business, because any company may become overvalued or unattractive given our criteria. An excellent example of this is Pepsi, a historically predictable and consistent company that we sold on April 18th of 2019 and then used the money from that sale to buy Tiffany & Co. at $78 per share. We had identified Pepsi as being overvalued on a couple of different valuation metrics, such as price to sales, price to cash flow, and enterprise value to earnings before interest and taxes. On this basis in particular, Pepsi had been at its highest level of valuation in almost 20 years. So as such, the decision to sell Pepsi locked in a gross rate of return of 142%, or about 12% on an annualized basis. Furthermore, since we sold Pepsi, the stock has grown about 10.5%. But since we bought into Tiffany, the stock has grown 70%. More importantly, our portfolio as a whole has grown 32%. From an opportunity cost perspective, the decision to sell Pepsi proved to be both logical and profitable.
In closing, by using these disciplines, Bulldog Investment Company has outperformed our benchmark, the S&P 500, year to date, over the last 52 weeks, 3 years, 5 years, 10 years, and since inception. Cumulatively, we have outperformed our benchmark by 169 percentage points. In Bulldog Investment Company, we believe the numbers tell a story. They tell a story of logic, discipline, and values delivering exceptional performance. We now open the room to questions. Thank you.